So IFRS 9, let's take a look at the timeline. Well, today's the 4th of October 2017. IFRS 9 basically goes live in not almost 3 months time. So quite a tense timeline, and the first annual statement basically compliant with IFRS 9 is due on the 31st of October. Of course, for those who basically offer or publish quarterly statements, it's already due on a quarterly basis. So then the first annual statement, quarterly statement to be published would be 31st of March already. So tightens the timeline even a little bit further. One big thing to mention is for IFRS 9 for hedge accounting, the standard setter, the International Standards Board, has an exemption. So for hedge accounting, the company can choose or select whether to still apply hedge accounting under IAS 39 for the time being, or move over to IFRS 9. Reason is that the macro hedge accounting standard is not yet published. So that's an important, let's say, fallback scenario to, at least for hedge accounting, stick to IAS 39 and move over at a later stage. Let's have a first quick look on what IFRS 9 is in general, while after we deep dive into hedge accounting. We have basically 3 big pieces. The first one is classification and measurement that changes from categorization of financial instruments from 4 categories to 3 categories. So all assets on your balance sheet need to be analyzed on classification and measurement. Secondly, it goes about impairment. Currently, there are a lot of discussions with clients going on around impairment of trade receivables. The big thing here is basically that we are changing from a incurred loss model, which was IAS 39, to an expected loss model. So you need to put a model in place to derive the impairments for the trade receivables. So that's quite a big issue, which is currently in the market. Thirdly is hedge accounting. We'll deep dive into that. And last but not least, all those 3 new requirements of IFRS 9 end up in a lot of new disclosure requirements for your statements. So what are the key changes of hedge accounting IFRS 9? The first one is the extension of allowed hedged item strategies. That was a big criticism to IAS 39, that it does not really allow economic hedging in the books. There was always a mismatch. So there's quite some good improvement, and we'll get to that in a bit. Secondly, there's the approach you might have heard about cost of hedging, which further potentially reduces P&L volatility. I'll talk about that in a bit as well. And simplification of effectiveness testing, that's something I think everyone is looking forward to. That makes it indeed a lot easier. There's the concept of rebalancing. What does that mean? That basically now allows to basically set up a hedge ratio, let's say 89%, 77%, which basically allows to also set up a hedge relation where you have a proxy hedge. That's basically in the commodity market where you have transportation costs included, which you can now extract. Or when you do a proxy hedge on currencies, when you, for example, hedge the onshore renminbi with the offshore renminbi, you have a basis risk between the two that tends to be changing. And here you have the possibility to adjust your hedge ratio over time to always be 100% effective. So always also a good thing for hedge accounting. There are some downsides. It's not always good in IFRS 9. We'll also see that later. But documentation requirements increase at inception of the hedge. You need to document even further how risk management strategy aligns with your hedging strategy. If you do rebalancing, for example, you need to put more and more in your hedge documentation at inception. So some more work here. And last but not least, unfortunately, quite a lot more work in the disclosures, where you need to add more information on hedge accounting. That's on the one hand qualitative, describing in more detail your hedging and risk management strategy, but also quantitative, adding tables on your hedge relations with nominals, changes over time, impacts to OCI and P&L, effectiveness ratios, and so on. what we see in the project that the last pit is sometimes forgotten. So if you're in the IFRS 9 projects, always have the disclosures in mind and think of them at an early stage to have them in the project setup ready. So let's take a look at the three biggest one, I'd say, extension of the allowed hedging items. So just a quick comparison. So we have basically components of hedging instruments. On a percentage basis, nothing changes. That has always been the case. So basically you can only designate percentages of your risk in hedge accounting, so no big issue here. Risk components, that's a big one, especially when it comes to commodity hedging. Everyone who was trying to put commodity hedging into hedge accounting is always difficult. You have transportation costs, you have differences between the hedge market and the physical market. That changes now here because now you're allowed basically to distract single risk items, put them in hedge accounting and have them 100% effective. So that's really a big improvement here for all with commodity risk in your books. Groups and net positions. Cross position, that has always been possible with some smaller exemptions in IAS 39, now very flexible in IFRS 9. And which is a big improvement is the net positions. Under IAS 39, you were not allowed really to net inflows and outflows to a net position. The workaround which was taken was that you said, well, I'm only hedging the first X and Y percentage of your inflows or outflows. Now you're really flexible to net all your positions on a group basis and only use those net bases as a basis of your external hedging. So it's also quite a big improvement here. And last but not least, synthetic hedged items, also a good improvement here. What is meant with that, for example, you have a commodity purchase in US dollar physically, and you hedge that with a forward to secure your price fluctuations on a commodity index. You can now use those two contracts as your underlying and hedge that against fluctuations in the currency risk with an FX forward. So you can basically build aggregated exposure out of operational, out of derivatives, pack them together and use them as a hedged item. So a derivative can be part of a hedged item, which was never really possible in IAS 39. Secondly, reduction in P&L volatility. That basically arises out of a concept which is called cost of hedging. That's basically three components. We have the time value of options. We have the forward points when you hedge, for example, with an FX forward. Or you have the cross-currency basis spread, for example, in cross-currency interest rate swaps. Those three components under IAS 39 always tended to get some ineffectiveness in the hedges. That therefore they're basically in P&L. Now IFRS 9 introduces the opportunity to basically put those components in a separate OCI item, so reduce all P&L volatility. We'll see that in a bit. So if you have, for example, you do hedge accounting with FX options. In the past, you had a decision either to designate only the intrinsic value or the full fair value of the option. You still have the choice now, but now you have the obligation that the time value goes in OCI, so you have no more P&L volatility if you hedge via FX options. For the other part, if you have FX forwards or cross-currency basis spreads, same thing. You can, of course, still decide whether you want to designate on a full fair value basis or only the spot component. That's still your decision. And then for those, you can even decide whether you want to put that extra component via P&L or an OCI. So for both, you now have basically the option to put all those cost of hedgings into OCI and have no more P&L volatility. You might ask, well, now you have those components in OCI, when do I release or recycle them from OCI? There are basically two approaches, point in time. So if you hedge, let's say, just an FX outflows, it's a one point in time event. You basically release the OCI at that single point in time. That's the first one. On the second one, if you hedge something over a lifetime, an issued bond where you do an interest hedge or something similar, then the OCI of that specific component is basically recycled over the lifetime of your hedge. So in both cases, the OCI is recycled when the underlying transaction really hits the balance sheet in order to offset the underlying transaction. So that's quite a big improvement. On the first side, of course, what's the challenge behind that? That's what we see in all the implementation projects. You need to be able to, in the first place, really separate those components. Is your treasury system able to really calculate a cross-currency swap without currency basis spread? Can you do the separation of forward component, spot component, and so on? So it adds quite some complexity to the market valuation itself, which needs to be clearly taken care of. The last one, which I wanted to deep dive into, is the simplification of the effectiveness test. Also something which is really easing up the rules here. Economic relationship, I mean, nothing has really changed there. The underlying and the hedge need to offset each other, and that offsetting effect cannot be just a coincidence. It needs to be planned by strategy, so nothing really new. Credit risk shall not dominate. That was also somewhat part of IAS 39, but not that clearly. Now it is. So in case of financial crisis, in case that changes in the fair value of a derivative are mainly dominated by changes in credit risk of your counterparty, that might lead to a de-designation of your hedge relationship. Hedge ratio determination, that goes in hand with the aspect around rebalancing. So when you just basically put in 89% of your hedge because you hedge renminbi onshore versus offshore, you need to state that, and you need to basically document and calibrate that hedge ratio. One of the biggest ones, probably all heard of that, the effectiveness bandwidth, or let's say the bright lines, 80, 125%, they're not there anymore. Which does not mean that everything goes to OCI. It just means that all hedge relations will remain in hedge accounting, not like in former times when you've been outside those borders, you had to basically stop hedge accounting, book the full fair value to P&L. That's not happening anymore. That will all be still in hedge accounting under IFRS 9. Prospective effectiveness test, nothing really changed. That is still required in IFRS 9 as well, but the retrospective one is skipped. So that's an easing up. And last but not least, which of course is still there, that goes also in line with the 8125, is the calculation of the effective measurement. So basically determining in euro or dollar terms which amount goes to OCI and which amount goes to P&L. So that one is still valid and important. But I think overall it eases up the effectiveness here on that side as well. So basically summing up, I think while providing potential to better align economic risk and accounting, I think that's very clear. There's a lot more potential to really get that in line, designate what is economic logical, and also get that in the books how you want it. It also introduces new rules, challenges when it comes to separating valuation, cross-currency spreads, bigger documentation, a lot of new disclosures. So it has its ups and downs, and it's very important to tackle those very early. I've shown on the first slide, there's just 3 months left on the first application, 1st of January. And I think most of the companies need to publish on the 31st of March their statements. So at latest at that point in time, you need to be compliant also with your auditor on respect to IFRS 9. So happy to discuss here later at our Deloitte booth, just around the corner, everything around IFRS 9. I mean, 15 minutes for a 800-page standard is kind of a challenge, but at least I try to point out the most important ones around hedge accounting.